Hello and welcome to a brand new edition of Market Makers. Markets at a record high, the big event risk which is budget that is behind us. So what really could be the trigger for Indian markets from here? Earnings, RBI policy, or it is still all about global liquidity? Central banks are committed to print more money, and that perhaps is the root reason why not only India but all markets are rallying. So how should one invest in this kind of a market where it's clearly about hope because earnings ain't coming? Nilesh Shah, CEO of Kotak AMC, joins us to discuss the current market setup. Nilesh, fantastic to have you back and thank you for joining us. You know, in isolation, we may feel happy that we are the best performing market in the region. But, if I look at the world around us, everything is moving in a synchronized manner. We may feel proud of our economy, but currently it's all about a rising tide phenomenon.
Definitely. There is enough liquidity in this system. World GDP was about $55 trillion in 2008 and $140 trillion was the debt. Today debt has moved to $200 trillion and world GDP has moved to $70 trillion. So to create $15 trillion of GDP, you are creating $60 trillion of debt. India, the case is reverse way. In world, you raise $1 of debt to create 25 cents of GDP. In India, at least we are in a better of position. So while others are going up on liquidity, we are going up on liquidity as well as fundamentals.
So I understand the case for India is strong, and the case for any economy is strong if there is productive growth and if earnings are strong. Productive growth for India has not kicked in yet, and earnings also are not reflecting anything special. So earnings are not coming, and that is the big vacuum.
Undoubtedly, the third quarter FY15 results have been quite disappointing. But the reasons for this disappointments are one-off. Our capacity utilization is at much lower level. Our working capital cycle is elongated. Our interest rates are higher than rest of the world. And most importantly, the commodity prices drop which occurred has created inventory losses which are getting amortized over a period of time. Now, these are all one-off events which will get even out over a period of time. No new capacity has been added up, so it is fair to assume that capacity utilization will start improving from current level, and maybe they'll reach peak utilization over next 2 years rather than next 2 months. The inventory write-offs will get amortized over probably next 1 quarter, and thereafter lower raw material prices will start reflecting into margin. The working capital cycle will start coming down, one, as commodity prices have come down, second, as the money starts circulating into the economy, and third, as interest rate starts coming down. So all these things will result into earnings acceleration in FY16 and more particularly in FY17. We think FY15 earnings growth will be below 5%. And we started the year at 15% earnings growth. But FY16 earnings growth will be probably, as per expectations, around 13 to 15%. But FY17 could be a bumper year where earnings growth could be 22% plus. So the market is looking at future, and probably some portions of the industry is looking at the past where they have seen bad results, disappointing results, but market is hoping that these are one-off events and this will soon be passé.
You know, if I scan through some of the strategy reports, it reminds me of an old movie dialogue, Tariq pe Tariq. 1 quarter, 1 more quarter, 1 more quarter. All the strategists perhaps 3 quarters ago were bullish, and they were of the view that Q3 or Q4 would be the turning point. Now, because market prices are high, I guess they're simply buying more and more time.
If we see from a valuation point of view, today we are trading at about 16.5 times forward earning. It's not very high or expensive valuation. The returns, if we see over the last 1 year, broadly, large caps have delivered about 37% return, mid caps about 60%, and small cap about 80%. Bulk of this return has come from PE re-rating. We moved from 12 to 16.5 PE. Not much has come from earnings growth. But going forward, we will actually see earnings growth driving more return. And which is why, the analysts are predicting future. Because the acceleration in earnings growth from 5 to 15 to 22 is pretty high. Now, will it get delayed by a quarter here or there? One doesn't know. Maybe it will get delayed. But certainly today, we have stars in our favor. Your current account deficit is becoming almost current account surplus. Fiscal consolidation is on its way. Government spending on infrastructure is on its way up. Liquidity wise, we are getting more capital inflows than probably we can absorb. The capacity utilization is at the lowest level. The M3 growth is at lowest level in 10 years. The profit margins are at lowest level in 10 years. So somewhere we are at the bottom, and from here we can hope to do a turnaround in near future, maybe delayed by 3 months, but the turnaround will be sharper, and which is why people are comfortable looking into the future and saying that, hey, at 16.5 times, if I can get share of an economy which is growing without creating credit bubble, it's worth it.
Let's also remind our viewers that the composition of the Sensex has changed. When we say 16.5 times, commodity is out,
Yep.
and some of the real estate stocks are out. So right now,
Precisely.
it's a very healthy looking Sensex in terms of companies and in terms of classification. Do you think bulk of the budget adjustment is behind us? That initial budget adjustment which we saw in some of the construction companies, cement companies, builders, road companies, construction majors, is that over?
So the stock specific adjustments are probably over. What happened with drop in tobacco companies' prices and what happened with the rise in construction companies' prices, that was expected. But I think the sector re-rating which should happen for the market, probably that's still not happened. There is still skepticism. Is the budget real? Is the budget for stock market? Is the budget for country? I think investors are missing a couple of things which has happened in the budget. One, this budget is a step in right direction to create one country, one market. We have for years lost on the leakages of fragmented markets. Hopefully in near future, and 1 year is not too distant, we'll have one country, one market where we'll benefit from the unification. Second, we have also suffered from the inefficiency in government spending. The leakages results into lesser productive result out of government spending. And the past experience does suggest that when we kind of, decentralize decision making at panchayati level, the efficiency of government spending went up. It is still not perfect, but it went up significantly. With more money in the state's pocket, we will be able to get more bang out of the government spending. So these two big changes which have occurred, which will make our growth supportive, along with that 70,000 crore extra which government is spending in railways and roads, has the ability to kickstart the economy. The investment revival can happen, sentiments can change, and we could see private entrepreneurs now stepping up to partner with the government in creating investment cycle, and that should result into growth getting on a sustained basis.
Everyone is of the view that the character of the market or the market behavior now has to change, which is consumers could see a time-wise stroke price-wise correction. They are expensive, whereas the old economy names, be it a construction company, a mining company or a road company, they will make a comeback, and that's where you will see the delta in earnings. Are you with the crowd? Or are you with the smart crowd? Or do you believe that if demand comes back, if growth comes back, consumers will also do well?
So there's no doubt that the consumers are today a bit on the expensive side in terms of they are at near all-time high valuation of themselves vis-a-vis their averages. But this is purely driven by lack of supply. If those consumer stocks are not going to give supply, and in some of those consumer stocks, the parent company is probably going to make an open offer for increasing a stake or delisting and taking away the float, maybe these prices will remain supported. But certainly at some point of time, valuations will catch up with them and there will be time correction. We have seen in the past where consumer companies stagnated for a while so that earnings could catch up. With economic growth, earnings will come even in consumer sector, but probably they'll underperform the market by virtue of kind of stagnation so that earnings can catch up with them. However, the old economy stocks, which have been deprived of the order flows in the past years, will certainly now benefit from the spending. So this year, government is providing 40,000 crore for road. At 8 crore a kilometer, it's about 5,000 kilometers of road. That is 2.5 times what we have built last time. So with this kind of sharp uptick in the infrastructure spending, certainly the old economy stocks will be in a far better environment than what they were before.
So what do you buy?
More importantly, in this sector, the competition has now come down. Yes. There are very few debt-free companies or less indebted companies which will participate in this upside. So this trade is not going to become crowded from a business point of view, and hence it will be more beneficial to the shareholders.
When the push is going to be so strong, I guess everyone will equally benefit. But how does one really pick the winners, and how should one really avoid the laggards? So I'm going to just spread the infrastructure space into 2 or 3 parts. One, you got service providers, construction companies. Then you got IP players or machinery companies, named like Cummins or Thomex. And then you got behemoths like L&T and to a large extent, maybe, Sesa Sterlite. Who will benefit the most?
So one, let's do the classification top down. We believe less indebted company or debt-free companies will benefit more than the companies which are hugely leveraged.
Okay.
Second, companies which have technological edge, and today it is certainly in favor of multinational companies rather than Indian companies, will continue to do well vis-a-vis their Indian counterparts.
MNC engineering companies, that's one.
They should be able to do better.
Okay.
The third thing which we'll have to see is again those companies which are focused on particular sectors like roads and railways probably will do far better than those companies which are concentrated in, say, power and telecom. So debt, specialization and technology, or the that moat in the business, that edge in the business, will determine who will be the winner.
Everyone has a favorite theme when it comes to the new administration: defense, railways, Swachh Bharat, digitization. What is your favorite theme?
My feeling is that in such kind of themes, it's very easy to get carried away. There was a fad at one point of time in telecom, media and technology sector.
TMT.
The winners were very few. Then, there was a fad in the engineering sector before that. Everything just went up. And today, some of those stocks are not even at 10% and 20% of those prices or those market cap. So, do evaluate all the opportunities, even in a sunrise sector, with a pinch of salt. Certainly when a company starts trading at very high valuation, because that sector is going to explode, you have to be extra careful.
What really could be the big theme or the big idea for 2015? Because for 2014 it was hope, a stable government, and a lot of global liquidity. There are 3 factors on which so far we've rallied. Will those 3 pillars remain intact, or now things will move to a different pillar?
So from an investor point of view, the biggest theme will be moderation. Okay. 2014 was a bumper year. 2015 will be moderating.
In absolute returns?
In absolute return. Second, the theme will be probably banking and financial services. These are the sectors which will lead the recovery. Unless until credit growth increases, you are unlikely to see GDP growth accelerating. Unless until credit growth accelerates, it's difficult to believe that earnings growth in most sectors will accelerate. There will be a few exceptions like technology and pharma, which are more global rather than local. So banking and financial services, even after the superior performance last year, should be in a position to lead the rally. Your deposit and credit growth is at about 12%. That's, on the lower side. So one, the growth rate will pick up. And second, the banks and financial services will also benefit from dropping or the softening interest rates. This two combination, along with a good bankruptcy law, which can help them recover their NPS, just changes the trajectory of the banking and financial services.
So one should allocate 25 to 30% of its capital in the banking sector.
One should be overweight private sector banks and non-banking financial services company, and one should selectively pick up PSU banks.
Why PSU banks? Because barring 2 or 3 top tier PSU banks, some would argue that most of the PSU banks are short on capital. Their book quality is still very opaque. Opaque is the word here. And when the economy will pick up, they will not be able to participate in the credit cycle.
So one, they'll be the maximum beneficiary of the softening interest rate cycle. Second, there are some fundamental changes which are happening in the PSU banking sector, where in few of the banks, the management will come from the outside of the PSU banking system. Third, clearly these banks have a huge liability franchise. And if that liability franchise can be leveraged appropriately on the asset side, at the current valuation, there will be enough money or enough room to make money. But again, you'll have to be very, very selective. Carte blanche investment in PSU bank is not recommended.
So private banks is more like a blanket buy. PSU banks is more like a pick and
Selective
choose
buying.
and identify your winners. Okay, let's migrate to IT. NASSCOM believes that for this year, which is 2015 calendar year, the growth could be double digit. And when they say double digit, they mean it for the industry. Now, if TCS, Infosys, HCL Tech and Wipro, if they continue to grow in double digit, that just tells you how strong the visibility is. And NASSCOM is considered to be conservative. Big companies always end up beating the NASSCOM numbers.
So clearly on the technology side, the driver for the movement will be more what happens to the currency and what happens in global economy. I mean, clearly over the last couple of quarters, the technology companies have withstood the global uncertainty quite well. And in 2014, they also benefited from the sharp currency depreciation. Now rupee is appreciated against yen, euro and GBP. That will have some impact on some of the companies' earnings which are more Europe focused or which are more Japan focused.
Cross currency, we've seen that in Q3 already.
The second thing which will determine is the rupee's movement. I mean, clearly the destiny of rupee is to depreciate due to the inflation differential. But the flows are so strong that it can probably cause a temporary appreciation. Now this makes rupee, albeit even in a range bound fashion, bit unpredictable. And we have seen rupee moving sharply against expectations of the most market participants. So how does the technology company hedge their rupee risk? That will also have some temporary impact onto the earnings and hence the valuation. So technology sector overall looks attractive, but please make adjustments for one, the cross currency impact of rupee appreciation if those companies have exposure over there, and second, their own hedging policy.
Why are IT stocks so cheap? The P multiples for large cap IT stocks are just in and around the index, and that's rarely that has rarely happened in the past. Last time when the P multiples for large cap IT stocks went below the Sensex P multiple was in 2008-2009 when there was serious global crisis.
So to some extent it is related to lower combined ROE because of the cash balance which they are carrying. So unlike FMCG company which declares more dividend or equal dividend to the profit they earn, the payout ratios in IT sector is to that extent limited, and which is probably the reason why the combined ROE comes down, and that has an impact on their valuation. The second thing is related to scale up. I mean, if you do the analysis of the past, it does suggest that unless until a company crosses $1 billion in size, it doesn't really transit from that small and mid cap space to the large cap. And so many companies who couldn't cross that hurdle of $1 billion started, becoming, let's say, in a very commonsensical parlance, a fixed income investment rather than equity investment.
They've peaked out or plateaued out.
The growth plateaued out.
Your size matters in this business.
The size matters. So you make maximum money when that company changes the orbit from a small and mid cap IT companies to large cap company. And there are very few examples of companies who have successfully done that.
Even the industry is 25 years old.
Industry is reasonably old.
I can count the $1 billion plus companies actually on my fingertip. Yeah, mid has always remained mid and large has always dominated, and those names haven't changed. Okay, let's change the scope of the discussion and talk about metals. If we are of the view that demand will come back and demand for cement will come back, then demand for steel will come back, demand for aluminum will come back. Does it make sense to be bearish on Indian metal companies, the companies which are inward looking, or metal is a global commodity, one is better off giving metal names a skip?
So one question which I am unable to find an answer, if China has 800 million ton steel capacity and they have already consumed more steel in 10 years than what US consumed for building its infrastructure over 100 years, what happens to that excess capacity? If they decide to put 10% of that in India, we don't require our steel plants.
But then we can create our boundaries.
Yes. Now, in a global environment, you just require 1 million ton of steel to come and impact your 80 million ton production cost. So in the metal space, we'll have to really worry about what happens globally and how does China use its huge capacity. Now, when you have opportunities in other sector, you can probably prefer to be far more careful on metal sector and probably use it more from a trading point of view to play on the global economic growth rather than be a fundamental investor over there.
So broadly, if I look at all asset classes, looks like we are in a very sweet spot. Interest rates will come down, which means debt markets will do well. Interest rates will come down, which means earnings will go up, and that's good news for equity investor. If I'm a very conservative HNI investor, retail investor, government will now issue tax-free bonds which will give me 8 to 9%. If I've got gold sitting in my bank locker, in my wardrobe, a gold monetization scheme is also coming out. So looks like अच्छे नहीं बहुत अच्छे दिन आ रहे हैं.
So definitely for the retail investor, it's a really good time to invest. We are equally bullish in debt market as well as equity market. And not that there will not be volatility. Of course, there will be volatility. But point-to-point return, if you can withstand that volatility, will still be superior in financial assets vis-a-vis physical assets.
Do you not worry about the frenzy in the mid and the small cap space? If I look at individual stocks in the mid cap space, be it Atul Auto or Aisha Motors, Bosch, I'm simply speaking quality names here, they are trading at PE multiples of 40 plus. A lot of mid cap stocks are commanding premiums which were higher than large cap stocks. And that kind of an valuation difference may not sustain. Mid caps historically have always traded at a discount to large cap stocks.
So definitely today, if we see the broad mid cap index versus broad large cap index, both of them are virtually trading at 16.5, 17 times forward earning. And we do believe that earnings will be back-ended rather than front-ended. And which is why our call right now is that you be selectively overweight large cap. And if you want to invest in mid caps, be very, very stock focused from a fund management point of view. And from an investor point of view, do an SIP. The mid caps will outperform large caps over a longer period of time, but they have a risk of underperformance in the shorter period of time because of the reasons which you mentioned. So if you want to come into mid caps, one, make it a smaller allocation of your portfolio and come via SIP rather than lump sum investment.
Okay, before we wrap, what is the biggest risk for this market? The motherhood statement is if something goes wrong globally. Now, everyone knows that if something goes wrong globally, it's a pack of cards which is based on global liquidity, things will come down. Apart from some global nasty shock or surprise, what is the risk?
So let me sum up global events in just one simple word. Today, whole of Russia is available at lesser than the market cap of Apple. At what point of time foreign investors say that, look, if I can get Russia for $500 billion vis-a-vis India's $1.7 trillion, maybe it's worth buying into Russia. At what point of time the FII fund manager says that if I can get Brazil at $800 billion, which is half of India, maybe let me buy Brazil. So at what point of time the relative cheapness of my peers start pushing flows into those markets rather than us.
But Russia and Brazil is oil, and oil is no longer in a super cycle, so to speak. So are we trying to compare apple and oranges?
No, certainly, we are trying to compare different countries. But at one point of time, the risk appetite of the investors could trigger saying that if I can buy whole of Russia, 25% of world's gas reserve, 17% of land mass, I can buy it at less than Apple's market cap and substantially discount to Apple's market cap. Maybe it's worth. So we'll have to see at what level relative valuation of India looks expensive to foreigners. But from a domestic market point of view, I think the only factor we have to watch is that does the earnings acceleration happens as per expectations of the market. Today we are looking at 16.5 times forward on a 15% earnings growth. But God forbid if that earnings trajectory becomes more back-ended, becomes more delayed, tarikh pe tarikh, then certainly to sustain markets at this valuation will become difficult.
So earnings, clearly it holds the key. Last year it was hope, now it has to be evidence.
Yes.
Nilesh, really appreciate your time. Glad you could join us, and thank you for such a lovely discussion.
Thank you.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.